The big headline to watch out for and analyze was the overseas commentary from Fed coming in that they would not change the stance in a hurry. And that is becoming the biggest talking point right now globally on how it will impact asset prices and risky assets. So we thought of getting you an FI voice today. Luke is joining us from Manulife in London. Luke, good afternoon there, and thanks so much for joining us. How did you really analyze the Fed commentary and the way markets are absorbing their commentary? It almost seemed that taper is certainty, but now much calming voice coming from the Fed. How are they reading the tea leaves?
Nadesh, and first of all, thank you again for having me. I think your introduction there is spot on. The market is digesting. We're all looking to the commentary of the Fed. We're all looking to see how they're going to behave and if and when they're going to start this tapering process. Now, my view on this is that the Fed has learned lessons. And, if we go back to 2013 with the taper tantrum, this, of course, had huge effects on markets and contagion. I think the Fed is being very deliberate in its approach. We are seeing a more hawkish stance, a more hawkish tone, but it's moderated. The Fed, to me, is communicating in such a way to say, we're going to keep our foot on the accelerator. We're going to take a very cautious approach to when we start moderating the extraordinary monetary and fiscal stimulus conditions that we're seeing. And as such, I think it gives the market more confidence that moves should be more orderly. Now, we always have to caution that missteps can be taken. But at the moment, we're looking at it in a very constructive fashion. But we do expect tapering to come. I do expect that message to continue to be delivered. And perhaps after Jackson Hole, we're going to see a clearer message from the Fed on when they really expect tapering to take place. And consensus at the moment is, broadly speaking, early in 2022.
Right. What are the macro indicators which you are reading carefully as somebody who watches all the asset classes closely to really understand which way the tide could be turning from here on?
Yeah, look, there's obviously a vast amount of macro data. And of course, what's critical is to sift through the noise and understand which of the data and which of the macro indicators are really driving market returns. Now, certainly our view is that we're seeing the more developed markets emerging from lockdown, emerging from COVID. We are seeing, vaccination rates are extremely high, certainly if you look in the US and Europe. And what we expect to continue to see there is the re-emergence, economies continuing to open up. But critical within that is I think, looking at consumer behavior. Increase in spending levels. Now, should that take place, it's likely to see an increase in services data. Now, the flip side to this, and as you say, we look across all asset classes and we look across the globe, the emerging markets, we are seeing something of a resurgence in infections. Southeast Asia, of course, most recently, and we're watching closely to see what the impact of that is going to be on the progress of those economies returning to a more normal state of affairs, and of course underpinning global growth, which is what is going to drive markets.
Right. Luke, what are your thoughts on the valuations right now? There has been a furious rally in emerging markets, in developed markets, and it's, but there's an argument that it is largely fueled by easy liquidity conditions. What are your thoughts on valuations versus flows?
Yeah, look, I think that's right. Obviously, as I mentioned earlier, the extremely accommodative monetary and fiscal conditions have made the investing opportunity set broad. And as you say, we have seen strong performance across the board. Now, more recently, EM has underperformed developed markets in sort of relative growth and liquidity. Now, what for me is really important to look at is how you think about your investing, how you think about your timelines. In the shorter term, I suspect that we're going to be in a more uncertain period. And, in the months ahead, we're likely to see more choppy market environments. And typically, you would expect the more volatile emerging markets to be greatly impacted by that. However, on a more strategic basis and selectively within emerging markets, because not all markets are equal, I suspect that we're going to see increasing opportunities to offer excess returns relative to developed market positions. But as I say, it's that shift between shorter term tactical versus more strategic positioning.
Right. So in this light, how much probability would you assign? So first is whether taper would actually start from mid of 23, and then the other, when in your view would risky assets start factoring that in? Because assumingly, clearly looking at the prices and values, they are not pricing it right now.
Look, this obviously is the question we ask ourselves on a daily basis as investors. As I mentioned earlier, I think the central view is tapering is in the pipeline. It's likely to be moderated. We're not going to see, or at least we're not expecting to see, any huge shocks, but it's probably coming, early stages of 2022. That's our base case at the moment. Now, how is this likely to impact markets? It's all a question, really, of the process of that tapering and how resilient economies and growth are at that time. For now, we've seen extraordinary growth rates, as you know. This is likely to continue through 2021 and early 2022. And then I suspect that what we're going to see is a moderating of that growth as the impact of monetary and fiscal stimulus wanes. And really what's going to be critical for risk assets is what the velocity of that change is, how accommodating things can remain. And of course, as the global economy goes back to a more open stance, if that consumer-driven growth can continue. And that would be supportive. Continue to watch earnings, and as ever, keep an eye on the absolute value of your risk assets relative to the global growth rates.
Right. Luke, my last question is, how are you really assessing the quality of growth? Just the latest GDP data, quarterly data coming out of China seem to be showing it's slowing down. US chugging very strong. What will lead the world out of this in terms of growth, which will be the biggest, strongest engine in your view, and also the quality of growth in emerging markets like India?
Yeah, look, this is one of the things that we're wrestling with at the moment. Our macro team regularly provide updates on their views on this. Now, growth, as I say, continues to run at historically high levels. This is going to moderate. I don't think there can be any doubt about that. Now, where we are in terms of the macro environment, if we are going to see the impact of monetary and fiscal stimulus moderate somewhat, then by definition, I would argue that we're probably at peak macro. And what I mean by that is peak macro being the most accommodative environments, which are most supportive of risk assets. We're also starting to see divergence across the globe in terms of quality of growth and what those drivers of growth are. If I look to the US, obviously there has been a huge amount of talk around the reflation trade and whether or not inflationary pressures are embedded within the economy. Our view is aligned with the Fed, frankly, that this is transitory, and looking through the headline data, which has been high, and obviously the most recent print higher than expected, but the devil is in the detail. What is the driver there? Many of those factors are going to start to roll off, so I expect inflation to moderate as we go forwards back towards target. If I look across to Asia, emerging markets, and India, China obviously a key driver. Yes, you're absolutely right. We're watching credit conditions very carefully because there has been a slowdown in the impetus there. However, let's not forget that there is plenty of powder dry, particularly in China. So that can be addressed if there are any signs that the growth rate is losing sufficient velocity. I think India, as we discussed previously on the last call, still offers some very attractive investment opportunities. emerging from COVID, emerging from lockdown, getting consumer spending back on board to drive that growth, an increase in the velocity of money, those are going to be the factors that will continue to give us confidence that there are outsized growth opportunities in those markets.
Right. All right, Luke, we'll let you go on that one. Thanks so much for joining us with those insights on markets and global macros. With that, we'll take a short break. On the other side of the break, we'll talk about the textile space. A buzzing stock will be joining us. On the other side, don't go anywhere.